Hey everyone, I'm Owen from Rask Finance. Welcome to the third lesson of the Value of Everything Value Investing video series, a free online course that will help you understand why and how analysts and investors calculate the value of all types of businesses, stocks, assets, and more. Visit us at www.raskfinance.com, where you can find this spreadsheet and loads of other educational content and courses. This is the third lesson, and it is all about the valuation of assets on a balance sheet. For those of you who have been watching along, we've covered relative valuation, and we've also gone over the purpose of valuation and what we'll cover in this course. As you'll see on the page right here, valuing assets is an old school share market technique that uses the balance sheet to determine growth, but it is also frequently used in private market valuation, and I've given you a hint as to why that might be the case, and it has something to do with competitive advantages. Basically, private companies generally don't have competitive advantages like some of the bigger companies listed on stock exchanges. For example, if you were valuing a bakery, your local bakery, chances are that bakery, although it may have some different recipes or some different marketing, it may not have a durable advantage, a durable competitive advantage, which enables it to earn superior results to anyone else in the industry. Okay, so something I forgot before we get stuck into the spreadsheet. This is a video for it, which includes general information for the purposes of education. It does not include financial advice, so please don't rely upon it or any of the information you see here. Okay, so the question we're trying to answer with this valuation model is, what would it take to reproduce Woolworths? Remember, Woolworths is our supermarket case study. And in this video, we're using the balance sheet to answer that question. In the other valuation models, using the other valuation models, we use mostly a company's cash flow statement or profit and loss. But in this tutorial, we're taking it from a different angle, which is the balance sheet. And one of the reasons we do that is simply to ground our valuation models. So when we value things using the profit and loss or income statement, a lot of the time it involves forecasts, which may or may not be wrong. They're more often wrong than right. But ultimately that requires us to make some forecasts using our own input, and so much of the time that is wrong. Whereas a balance sheet is simply a snapshot in time. So if you have any familiarity with balance sheets, you'll know that it is taken at a point in time. So for example, this data that we have here from Woolworths' balance sheet is taken at the end of the 2017 financial year. The income statement shows perhaps what happened throughout the year, whereas the balance sheet is just that point in time. And all of the information we have here, so all these numbers and these little notes here relate to the annual report, the 2017 annual report, which you can find here and in the sources below, which is just here. Okay, so back to the topic at hand. We are valuing Woolworths from the balance sheet. So the way we do that is by taking each item on the balance sheet. So here we have cash. We make an adjustment depending on whether or not that item from the balance sheet will be required to be reproduced in a new business. So let me clear that up for you. So Woolworths had about $909 million of cash in 2017. If we were to start a new business which is identical to Woolworths, would we require that $909 million to reproduce the business? The answer is we would. Simply because if Woolworths has cash on its balance sheet and we want to reproduce a business that is exactly the same as Woolworths, we'll need 100% of that cash. So there's no adjustment here. You can see that what it's got on this balance sheet goes straight across to this final cell here. Trade receivables. Basically, this is what Woolworths records on its balance sheet for doing business. So, for example, it has suppliers and customers that may or may not pay on the day. So when you go into a store at Woolworths, you might buy some groceries and you may pay for them on credit. Basically, Woolworths has to recognise that on their balance sheet as saying that that is an asset. Although we haven't been paid yet, it's something that we expect to be paid in the near future. And what Woolworths accountants do is they will adjust this number, this 744 here, for any likely impairments or customers that simply won't pay them. So what the accountants have done is, if you go to the notes in 3.1, you'll note that the accountants have deducted 14.8 million and 19.3 million. So what I've done is I've added them back because I have said that any new competitor to the market will have to recognise the total amount of trade receivables to be exactly the same as Woolworths. They will need that entire amount. They won't adjust for impairments because they don't know the impairments. Simply everything that Woolworths has done up until today, that's exactly what we need. Inventory, this can get quite complicated. The best way to understand what's going on is to read the notes in the financial statements. Woolworths records its inventory, so you can think of like cans of Coke, chips, fruit and vegetables, etc. It records it at the cost or net realizable value, whichever is lower. So Woolworths carries an item, say a can of Coke, at 50 cents until it is sold, and then it is recognised as a cost of goods sold. Sometimes you can have first in, first out, last in, first out, and all different types of weird and wonderful accounting tricks that are played by companies and their accountants. Just for simplicity here, we've said that a new competitor entering this market to reproduce exactly what Woolworths has would need 100% of the inventory on its balance sheet, which is $4.08 billion. Other financial assets, you can see here it's a very small item, so I won't go into too much detail, but basically it's just derivatives. I've said a new competitor would need that. A derivative, in this case, might be, say, Woolworths buying products from international markets, and it may hedge out the currency risk, so it holds derivative products that enable it to do that. Assets held for sale. This is a somewhat unique one, so why have we included assets held for sale? Basically, if a company wanted to reproduce exactly what Woolworths has, even though it is selling these two businesses up here in the brackets, EasyBuy and its petrol business, even though it is selling them, they are still on the balance sheet, and we are valuing Woolworths as of today. And this is its most recent balance sheet, so it is recorded in our valuation model at 100%, because that's the accountant's value, and I have no reason to adjust for that. I have no special insight that says that EasyBuy or Woolworths' petrol business is worth more or less. If I thought it was worth more, I would have to add something to this column. So if I thought that those businesses were worth more, I would have to add there, and you'd see it would go up. If I thought it was worth less than what Woolworths is saying, then obviously I put 80%, it would go down. But we're keeping it at 100 just to keep it simple. Okay, non-current assets. Woolworths has longer term trade receivables. Remember, we covered them up here. No adjustment. And the reason why I've made no adjustment is simply because this 19.3 was actually for the non-current assets, but I just included it up there. So we're saying that any competitor will have to take 100% of what Woolworths is recognising here on its balance sheet and reproduce that. Financial assets, once again, derivatives. There's a reason why this is a much larger number than this financial asset item here, and it's simply because Woolworths holds shares in other companies that are listed on the stock exchange. So it holds derivatives, but it also holds listed shares. And I've carried that across at 100%, and I haven't made any changes for the value of those listed shares. I mean, we could go through and value the companies that Woolworths holds. So for example, if it held shares in a smaller supplier of products, we could go through and value that business. But for the purposes of this video, we'll just keep it simple and say Woolworths could sell those shares on market at any moment for the carrying value, and the carrying value being what's on the balance sheet. So we've just recognised 100% of that. Okay, property, plant and equipment is where it starts to get interesting. So when you start a business, you would obviously have to build it from the ground up. And in Woolworths' case, to build a supermarket, you'd need warehouses, distribution centres, you would need fridges, trucks, all types of things. You need technology systems, all that type of thing. So what happens is there's generally a massive outlay at the beginning of the business. And then over time, just like you would on an income tax return, you depreciate the value of those assets to signify that the value is eroding over time. For example, if Woolworths buys a fridge for, say, $100,000, and that fridge is likely to be used for 3 years, well, each year you would take off 30% of that carrying value of that asset. But what that means for a new competitor is that they must pay $100,000 today. So what's essentially put on Woolworths' balance sheet may not be a realistic snapshot of what a new competitor would have to add in. So the way you'd have to adjust for this is you'd have to go into the notes and see what the company is doing. What depreciation schedules does it have? Does it depreciate its fridges over 3 years? Does it do it over 2 years? Does it do it over 10 years? Are the buildings depreciated? If so, over how long? And are they conservative? Are they correct? Basically, you'll have to add an amount into this column to adjust for the fact that Woolworths may not be showing the realistic value that it would take to reproduce those assets. So if we go down here quickly, you'll notice that I've done a little table here, and I've said that property does not depreciate, but will be tested for impairment and revalued periodically. So this is important to note. Property does not depreciate over time, but property actually increases over time. So independent valuers will come along and value Woolworths' property periodically, and then it'll be shown in the balance sheet. Plant and equipment. So this is an example of something that might depreciate. So say like fridges or buildings, for example. So Woolworths' depreciation and amortization in 2017 was large. It has a lot of equipment. Some of Woolworths' equipment is being depreciated over 2.5 years, when the useful life is likely longer than that. Of the large equipment value and pace of depreciation, a new competitor would be forced to pay more than what actually appears on the balance sheet. And I said, see the comment here. So I have added this amount because a new competitor will be required to buy plant in today's dollars, not at the prices from years ago, that is when Woolworths purchased it. Woolworths also depreciates some items over 2.5 years. That is very quick. Therefore, a new competitor would be required to pay for more equipment at higher prices than the after depreciation amount shown on the balance sheet, aka carrying value. So let me just make sense of that. If I bought my car 5 years ago for $20,000 and I've depreciated it at $3,000 a year, the current value of that car would be much less than if you had to buy that car today. So what we've done, instead of saying a car, we've said everything on Woolworths' balance sheet. I've added back $3 billion here. So you can see that gets added back up here, and we've adjusted upwards the property, plant and equipment to $11.4 billion. Realistically, that is very conservative because Woolworths likely has things on its balance sheet that have been there for many, many years, perhaps even decades. And for me to say that all a new firm would need to do is add on $3 billion on top of the $8.4 billion to reproduce the assets of Woolworths business, I think that's very conservative. However, I've just done it for simplicity. If you wanted to add more in, you could easily just come into the spreadsheet and type away whatever you like. You'd have to type it in here. I'll just quickly do that so you know. Okay, now let's move on to the next one, intangibles. Where does this come from? That's the important question here. Remember, intangibles includes things like brand name. It includes things like goodwill that for prior acquisitions that Woolworths has undertaken. So, for example, much of this goodwill for Woolworths comes from its acquisitions that it made in New Zealand. So let's go to note 3.4. Where are we? 3.4. Here we go. Okay, you can see that Woolworths has $4.3 billion of goodwill. That's a fair amount. And these essentially have come from acquisitions in the past. You can see here that the goodwill has come, a lot of it has come from the New Zealand business that Woolworths has obviously purchased in the past. It's also got some for brand names here, carrying value. It's also a liquor business, like a hotels, pubs business. And you can see here, how these are accounted for on the balance sheet. But getting back to our spreadsheet, I've decided to carry them at 100%. I've said that what Woolworths has accounted for on its balance sheet is conservative. It's the right amount. So I've said 100% of whatever the accountants believe the intangibles are is $6.5 billion. And a new competitor entering the market would generally be required to pay that amount. Woolworths does have brand names here in Australia and in New Zealand. So we can't undervalue that because that does generate some return for the business. I won't say it is much, but that does generate some return for the business. Finally, on the non-current assets, deferred tax assets. So we'd have to look at the notes and say, to be really comprehensive, we'd have to look at the notes and say that Woolworths has $370 million of deferred tax assets. When are we likely to, or when is Woolworths likely to recognise them? And then when we discount them back to today's dollars. For simplicity, once again, I've just said that we're carrying it at 100% of the value and that a new competitor would have to have deferred tax assets, even though they may not. In real life, if a new competitor sprung up today, they may not have deferred tax assets. Although they could have more, they could have less. There's no way for me to really know for certain, so I've just said we'll carry that at 100%. On the liabilities side of the balance sheet, you'll notice that I haven't made too many changes. have either carried it at book value or market value. I've said here, however, that tax payable, a new entrant wouldn't have to pay this, so we'll carry that at 0. Financial liabilities, book value, provisions, book value. So basically what I've said here is we're keeping these very simple. With these types of valuations, I think to myself that whatever's most conservative, I don't want to have an input that is particularly aggressive and say, oh, well, I don't think Woolworths debt is actually worth current debt is worth 250 million, or I don't think its long-term debt is worth $2.77 billion. I think it is worth less. And then ultimately, by saying that the current liabilities or non-current liabilities are worth less, obviously we're inflating the value of the business. Remember, with valuation, it's generally better to be generally right than specifically wrong, rather. So I just tend to be conservative and just shave off anything that I think is perhaps too difficult for me to be specifically right, and just err on the side of caution. So I've said here that the borrowings that Woolworths has are fair. The book value represents market value. But obviously if this business was in liquidation, so say if Woolworths was really struggling and we were valuing the business as though it was about to go out of business, its debt would probably be a lot cheaper than what's carried on the balance sheet. So there might be an opportunity there for a debt investor to come along and actually say, well, this business actually looks quite good. If we can remove that debt, then we can revalue it and make some money. But for our sake, we've just kept it simple at 100%. So you can see all those values. Okay, there's one thing that I didn't go over, and this was the extra items, so the hidden or off balance sheet items. Now this one's really important, and it becomes more and more important, I suppose, as time goes on, because we're seeing an emergence of more tech companies, and companies focus on research and development to produce a service or product. So up here we said that Woolworths brand is worth something. Sometimes brands aren't worth that much, so you must be careful not to overpay for them. However, when it comes to reproducing a business, there are more things than just brands which go into making a great business. And one of the things is research and development. So if you were valuing a company like Apple, you would have to say, Apple has been creating smartphones and software for many, many, many years. And if a new competitor were to emerge, it would take many, many years of development and know-how and capital to reproduce a business similar to Apple. So you would have to factor that in, and the way you would do that would be to look back at the past and say, what percentage of earnings has Apple historically paid to get to where it is today? And then you would have to adjust for any advancements in technology or know-how in the general marketplace and say, what is a realistic value of all the research and development that's gone before to get a company to where it is today? Fortunately for us, Woolworths doesn't have much R&D. Supermarket businesses don't require that much technology or research and development expenses, so I've just put a no adjustment here. But one thing they do have, and one thing big supermarkets do have, is marketing and advertising. So they generally have large budgets when it comes to television commercials, online advertising, or even roadside advertising. And they also have extensive back office operations. So for example, when you go into a Woolworths store, there's obviously people on the floor, there's customer service representatives, but a lot of the marketing, a lot of the systems, and a lot of the efforts that go on to get products on the shelf are not undertaken at the store level. They're undertaken by corporate and headquarters and distribution centers and the like. And we've obviously got to appreciate that in our valuation. So we've got to say, not only does Woolworths have a big marketing and advertising budget that a competitor would need to reproduce, it also has a lot of administration expenses that go on, for example, at corporate headquarters, and it would take a long time to reproduce or replace this. And obviously that's what we're trying to do here. We're trying to value Woolworths as if we were replacing it or reproducing it. So it's important, let's not think only about marketing, but also HR, recruiting, systems and processes. So we have to put a value to all that. So one way I did that is I said, Woolworths selling, general and administration, which I just got from the annual report, was $10.5 billion last year. I'm saying that a new competitor would need to spend 100% of that to get to where Woolworths is today. So let's just think about that. 100% of last year's selling, general and administration. What I'm actually saying is it would take 1 year's worth of expenses to get a new competitor up and running and selling product like Woolworths. 1 year. There's obviously something wrong with that. It would generally take longer than that. But just for the sake of our valuation, I put 100% here. Just kept it simple. You could come into the spreadsheet and you could put in 200%, and you could see that that's a big expense. That's a big asset that Woolworths has, and a big advantage that it has over its competitors because it's already in the market. We'll keep it at 100%. So this asset, we also obviously need to adjust the value of our assets up the top here for this extra hidden asset that Woolworths has, which is $10.5 billion. So what I've done just here is I've taken the value of its hidden assets and I've added it to the value of its total assets to get to this figure. Then we have the value of the liabilities. Remember, we've kept it quite conservative and said there's no changes to any of the liabilities. What you see is what you get, which is this value right in this cell right here. And we've carried that down here. And then we've got the number of shares. Remember, anything in yellow feeds in from this main page here. So we've got the number of shares, 1,294 million shares. And we've simply divided that total number, so these two up the top here, divided by the number of shares. I shouldn't have said total. What I've should have said is the net amount. So assets minus liabilities divided by the number of shares equals asset valuation per share. And then we've got the current price, which once again feeds in from the main sheet. And you can see here that our asset valuation is $18.19. So we've said, in summary, that the value of all of Woolworths' assets for a new competitor to come in, what would it take to reproduce Woolworths, minus its liabilities and hidden assets, remember we've added them in, is $18.19 per share. Remember, we've been conservative too, so you may go through and change some of these figures, but this is just for learning, obviously, so I've put this here. All we've got left to do is to add this to our main sheet here. So we're going to, so that is equal to this. And you'll remember from the first video that we did on relative valuation that we only had one valuation model. These are obviously all the models that we're covering. We just put it 100% for the sake of it. So what I'm going to do is just make them evenly split to say that we've got a 50-50 split. You can see because these two are so close and they've got such a similar weighting, the valuation hasn't changed much and the current market price is still $25 or just above, which means that our valuation is still significantly below the market price. Okay, now I wanted to also introduce you to this idea of net nets, and this comes from Ben Graham, the mentor of Warren Buffett. I'm just going to be quick with this because we don't really get much from it, simply because when Graham was doing a lot of his cigar butt investing and finding undervalued shares, there was a real absence of information, especially dynamic information that is fed directly to you each minute of every day. Unlike today, where you can pick up your smartphone and you can find out the share price or financial information of any company. And if you were so inclined, you could trade shares almost immediately. Back in Graham's day, he would receive a report and he would simply use a formula to try and find something that is undervalued, because he would be able to move before anyone else was using a similar formula or anything like that. So his approach was very, very conservative. I said we've been conservative up here, but his was even more conservative. So it's called the net nets approach. Basically, Graham would take the current assets or assets that are very likely reliable from a company's balance sheet. So that's what I've done up here. I've simply got all the current assets that Graham would have used, which is cash, accounts receivable, and inventory. And then he would have given it a discount factor similar to what we have. So we've made adjustments up above for some assets like property, plant, and equipment, except he would have been even more conservative and used only current assets. So he would have said, okay, cash is cash. It's worth 100% of what it says. We can get that from the business. Even if it goes bankrupt, there should be cash on the balance sheet. Accounts receivable, he said, the company says there's $744 million that's owed to it. But chances are, if we're liquidating this business, they won't all pay. So we have to adjust for that. Inventory, he said that, if this business is going out of business, those cans of Coke that were bought 2 years ago have probably lost their fizz. Or those apples and bananas that were bought 6 months ago, well, they're definitely rotten, so no one's going to really buy them. So he would take a conservative discount and apply that to the inventory that is shown on the company's balance sheet. And here you can see that that's the adjusted figure. And then he would total them up. All right, that's the first net. The second net was that he would get total liabilities. So not just liabilities that apply to current assets. So essentially what he's done is he's picked and choose what he wanted from this section, but then he's taken all the liabilities from these sections and netted them off. So he says down here, we can see, keep going, just here, that the total liabilities are $13 billion, and we're taking 100% of them. There's no reason for us to doubt them, which is $13 billion. So then we've got total assets in the business, current assets, minus total liabilities, and that's our result. So there's a negative value there. What Ben Graham was looking for was opportunities where the current assets outweighed the long-term liabilities. So if, let's just say, for example, that there was $50 billion of cash on Woolworths' balance sheet, that's very unlikely, but let's just say that there was. You can see that the total value of current assets goes up. It's lost its thing. So you can see that the total value of the current assets goes up. Liabilities are still the same, for example. There's the shares on issue. Remember, that's just pulled in from above. And that would produce a net current asset value per share of $31.38. Now, just to go even one more step to be conservative, Graham would target shares that were at least 33% or 1/3 undervalued. So if we had a company that had a share price of $100, it would have to be valued at least $133 for Graham to buy. And now you're probably thinking that this is crazy. How conservative is all of this? And it's true. Unfortunately for us, we don't get many opportunities where we can buy shares for essentially just their current assets netted off. Graham wouldn't always just use current assets. He might use some long-term assets, but generally it was all current assets. But it is very rare that you find these, particularly with quality companies. I mean, most of the time they're terrible businesses. So a lot of the time the businesses that have these value attributes are ugly businesses, simply businesses that you don't want to own. And if you're a long-term holder, the type that forgets about something, well, it's probably not the type of investing for you. But that's the NetNet's approach. If you can find something like that, be sure to share it with me. I'd be very interested. So anyway, in summary, we've taken the asset values, adjusted them to come up with a valuation per share. We've adjusted for hidden items. We've adjusted for our changes in property, plant, and equipment. We've netted those off. So we've said all those assets minus liabilities divided by number of shares equals our valuation per share. And we've fed that back into our model, which will soon be more filled up with some of our other valuation models. So I hope I didn't speak too quick. I didn't want to take too long with this because it's not the type of valuation formula you'll be using often. But if you have any questions, make sure you find me on Twitter at Owen Rask or with the handle at Rask Finance. And also you can access this slideshow, this spreadsheet rather, online at raskfinance.com. So I'll just show you where you can find it. You just click on whichever tutorial you're doing, and then you'll see that you can download the items here. So be sure to check back in for our next tutorial, which is earnings power value, where we're going to cover the value of growth, dividend discount models, and discounted cash flow analysis, which will be much more interesting. So until next time, thanks for watching, and I'll see you then.